Well, hey, before we get going, let's give a round of applause for Terry. We put a lot of sweat in pretty cool. Appreciate you putting me. Yeah, so we're all lucky to be associated with Terry. Can we zoom back out? Or I guess just a little.
Whatever you tell me what you want me to do.
Well, actually, how about let's survey the crowd. How well can we read what's on the screen? Because I can see it just fine. I'm right here now.
Not me, just a
That
little
would
bit.
make it funnier for being young.
Yeah, I will say there are slides with a lot smaller font than this, so buyer beware. But yeah, so I wanted to start with some book recommendations because I think Terry's gone over some awesome information. I've got some interesting stuff for you guys, and I think Matt's going to have some really detailed things as well. Which this is all really helpful information, but it's a lot to take in one time. So I don't think we're all going to retain some of this, but not necessarily all of this. So here are some books that I think are extremely relevant to either whether it's what I'm talking about or what we're going through as a group today. So some of these are really well-known books, like Psychology of Money and Die with Zero are relatively recent books. Both Morgan Housel and Bill Perkins are both successful hedge fund managers that have written very practical books on money. So Psychology of Money is more about like behavioral and, as the name implies, psychological interaction. Yeah, it's a really interesting read. And then Die with Zero is about being intentional with your money and your choices as it relates to personal finance. Atomic Habits might be my favorite book on this list. It's not directly about finance, but it's a lot about choices and what's possible with good habits. And I think there's a good quote. I don't know if it's necessarily from that book, but a quote that really stuck with me over time is a lot of people, when we're talking about things like goals or what you want to accomplish, overestimate what's possible in a year's time, but tend to greatly underestimate what's possible in 3 to 5 years' time. And so I think I think that's really true in money. A lot of people have really been like, oh, I want to buy a house next year, and then they don't necessarily achieve that goal. And then sometimes the perceived failure of something like that can throw them off doing something that actually was realistic in 2 to 3 years or things like that. So it's interesting. Simple Wealth, Inevitable Wealth is probably the least famous, but maybe my second or favorite book on this list. It's at one point, I don't know if this is still true, Nick Murray is a self-published author, and at one point this book was the most successful as it relates to sales self-published book. Unshakable by Tony Robbins. That is a personal finance book. Tony Robbins, pretty famous self-help guru, I guess. And so that's probably the only book on here I haven't at least started to read. And then Outlive by Peter Attia. This is probably the most recent book, and it's for sure the only book on here that has nothing to do with personal finance. It is completely about living a long life and living a healthy life, and I think that doesn't get addressed enough as it relates to planning your money, because what's the point if we can't enjoy it when we arrive? And I think America is oftentimes has the wrong headline. We're getting the wrong headlines for our health. We're living longer, which is good, but we're not living better. We tend to live a lot longer as we have throughout history, but we're very chronically ill. And this book talks about maintaining your health as long as possible and living as long as possible. So I want to kind of get started there. So I think I would jot down a few of those because I think there's a lot of wisdom in these books that I've taken that I think we'll circle back to in these slides. But it'd be good just to kind of continue your own journey offline going forward. So now more to the main portion. So this says Investing Basics. That's just kind of the off-the-rack title of the presentation, so I've kind of made some customizations here. But I think this 5-step strategy or way to go about this is just to kind of keep in the back of your mind as we're talking through everything, because this cycle of action steps can be kind of used in any perspective as it relates to investment planning or financial planning or whatever it is that you're focused on. So goal setting, risk and reward, diversification, and discipline and momentum. We'll kind of break down each one. First one being goals. And so one of the things as it relates to setting goals, we kind of just hit on it. People do overestimate what's possible generally in a year. Not always, but again, we're talking generalities. And then they underestimate what's possible in 3 to 5 years. And some of the research, why do people underestimate what's possible in the 3 to 5 year stretch, is that the further out our goals tend to be, the harder it is to get specific about those things. Hey, I want to retire someday. I'm 34, I'll be 35 in a week or two. When I think about retirement, I don't know it's hard to really materialize what that is going to be for me. Whereas, I just had a kid, where we want to send him to school or to college someday, those things are a little bit easier to visualize. And some of the goals I have for next year are definitely a lot easier to visualize. But to really have effective planning, we do need to get as specific as possible. So that doesn't mean, Debbie, it has to, am I going to force you guys to write down all your goals today? Of course not. But I think as you guys move forward and consider these things, whether it's on your own or with an advisor, the more specific you can get, or at least have some form, I want to go on vacation is different. It doesn't necessarily mean hey, I've got this particular villa picked out in France that I have to go to. It's that there's a lot in between there that the more we can get some specificity behind those goals, the better. And so again, when we say specific, measurable, time frame, resources defined, and action steps. So some of that measurable and time frame that comes to, what do I want my goals to be? When do I want to have them? Versus resources defined and action steps, that's more on the landscape of, what do I need to do to get there? Hey, I want to buy a house and I want to live in Cedarburg or whatever, right? So, or hey, do I want to buy a house and I want to live in Lake Forest, Illinois? Those are wonderful neighborhoods respectively, but one costs a lot more. So maybe I have the resources to live in Lake Forest someday, but maybe that's going to take me 15 years to save for that, whereas, Cedarburg maybe takes me 3 years. And is it a certain type of home? And then action steps, what's required or what's possible to get there. So risk and reward. So we're going to talk a lot about, what risk is and what it's not. Because I think, the stock market, we'll go through a lot of slides. That's where it's going to get really squinty and we might want to move a little bit forward. But when we talk about risk in the market, what I would really encourage you to consider is replace the term risk with volatility. And so what we mean by volatility is how quickly does the market behave? How fast does it move? Whether that's good or bad. So in the last roughly 18 months, it's been bad, right? But there has been some rebound, but I guess to take a quick step back, as we talk about the market, we're going to reference the S&P 500 generally as we talk. So the S&P 500 is the biggest 500 publicly traded companies in the United States. So whether or not you feel like you're familiar with this stuff, you probably are a lot more familiar than you realized. So all of the S&P 500 is probably companies you've heard of. So something, every big bank, Wells Fargo, JP Morgan, Chase, Exxon Mobil, BP, Amoco, those types of oil companies, or more fun stuff like Amazon. That's an S&P 500 company. So if you started rattling off big companies you're familiar with, they're probably on the S&P 500. So as we talk about the market, at least for today's purposes and compare, to simplify things, that's what we're going to reference. So we're talking about volatility. How quickly does it move? And so back in December of 21, the S&P 500 had an all-time high, or market had an all-time high of the index was at about 4,800. And so right now it's about 4,300, right? So it's come back. Last year the low was about 3,500. So it's gone down quite a bit. It's come back. But when we say risk in the market, it's how quickly do these things behave? So how quickly can it go up? How quickly can it go down? So volatility, natural part, but if the more you can train yourself, because risk sometimes can imply that I'm going to lose everything. And that tends to be one of the deep-rooted fears that I suppose is possible, but if we consider what the S&P 500 is, and losing everything would mean that every single one of those companies, all at the same time, would need to go bankrupt and cease to exist. So like Terry brought up Lehman Brothers earlier. Every single company, so Amazon, Google, JP Morgan, Chase, all on down the line, all of them at the same time would need to go bankrupt and not exist as a company anymore. So again, nothing ever is guaranteed, but that's a pretty extreme scenario that is hard to conceptualize. How is that possible? So a couple of things to get out of the way before we go deeper on volatility and the history of the market is that there's a lot of risks that can throw off your investments that have nothing to do with investments, which again, this kind of comes back to this theme that, like Terry referenced in a couple of his talks, is that what's right for you, or having a plan, or having an understanding of what's right for your situation, because all of these risks that, this is just a short list, like common things or big, easily identifiable things, but they're not the only risks in the world. But these are all things that, a car accident, right? The car accident, or like auto repairs in general, that can be kind of a thorn on all of our sides, is that every time I go to my oil change, I find myself, spending $700 to fix something else that's wrong with the car. So those are, under the category of what we'd refer to as high frequency, low impact risks. So generally, these are things that can be addressed with a rainy day fund. Because if we don't have a rainy day fund and we just go off to the races with investments, well, now we kind of get a little backwards to say, hey, maybe I have to take that early penalized withdrawal from my 401k, or a good performing investment account that I have to liquidate to go address this, something that could have been addressed by a rainy day fund. So house fire, flood, that's pretty extreme. Injury, illness, disability, again, what happens if my income is derailed because of some change in health? Long-term care, that's more of a retirement thing. We can circle back to that if we have time. And then, again, really extreme, but what happens if a loved one dies? How does that impact my financial situation? So these are all things that aren't directly involved with the stock market that are risks. So I think we'll push these things to the side, because our general philosophy is address your risks first, then invest. But let's just say we've just done all that. So risk tolerance is part of it. So again, the market is going to do what it's going to do regardless of your situation or how you feel about it. So we hear the term risk tolerance, and that can be applied in a variety of different ways, but it can be isolated or combined as what's my overall risk tolerance. So this talks about the 6 or 5 points here: investment time frame, withdrawal time frame, stable assets. I think I'd say I'd combine personal or stable assets and personal liquidity. That should kind of just be a rainy day fund. And then income stability. So all these things can factor into how much risk can you afford to take. So this is kind of compared to like a left brain, right brain, logical versus emotional, just like anything else in personality, in that these types of things can help quantify how much risk you should be taking or can be taking. But then there's this whole other side that matters, that's harder to quantify, is how comfortable am I with these things? And some of that is, again, if you're doing your own financial planning, that can work out really well, but those are the things that are harder to maybe either be honest with ourselves or truly identify. But they all very much matter. When the market's gone, again, this isn't for us to talk about right now, but you kind of do a little gut check. As the market's not done well over the last 18 months, how does that make you feel? How do those feelings result in actions? And again, depending on your age and your investment experience, think about 2008. How did you feel at that time? What were the decisions that you made? How did that impact your course of action? Because it's not meant to judge yourself on, did I make the right or wrong decision? But it is a really good litmus test, is how comfortable are you with volatility? Because some of the things that we're going to go through is that these things can be scary and we don't really know what's going to happen in the moment. But what history shows is that these things turn around. We just don't have a really good idea of how and when. And part of the problem is we can never really see them coming, right? Like we didn't, back in COVID, we didn't really know, like COVID was it swine flu? Was it SARS? Was it, the whatever problem of the day that the news cycle always throws at us? But it turns out it was a real problem that had a real impact on the economy. And things like 2008, there was a lot of bad behavior going on in the lending community, and we didn't really know about it. And then it slapped us in the face with the Great Recession. And so the point is that what we're going through right now is, an inflationary battle that is somewhat of an echo from the way we handled COVID, which is not right or wrong, but it is a result of a lot of those things. And the next time that something like this happens, we're probably not going to see it coming. And so the point is that risk tolerance is something that is both quantifiable and unquantifiable, and you need to figure out what the right thing is for you. Because someone like me, I'm probably a lot more comfortable with risk than a lot of people. Some of that is my own personal experience working with this day in, day out, being a little bit more exposed to the history of these things, and having to go deep on analytical discussions and just seeing a lot more information than a lot of people have access to. Whereas there are other people that just are not very comfortable with volatility and want to focus on stability. So it doesn't mean my personal outlook is right and their personal outlook is wrong, or vice versa. It doesn't mean I'm wrong and they're right, but it does mean that maybe I'm going to take a different approach. And so my approach isn't necessarily what all of my clients take or what we advise to them. What we need from clients, or what people who are doing their own financial planning, is just need to understand, what's my overall comfort, and or what is the goal I'm investing for, right? So you don't have to have just one big fat portfolio that has one risk tolerance. You can invest for, my timeline for my son's college is 18 years, whereas my timeline for my retirement is probably 30, right? Those are two different risk tolerances just because we have more time to invest for our retirement. Okay, so this is kind of small, but this is where I'm going to lead you guys through some notes to jot down. So on the front page, so most of this little handout is not meant for note taking. I think what this handout is really helpful for is just journaling, more or less journaling on your own, or just kind of as your wheels get turning. There's just a lot of questions in here that are directed back at you to say things like risk tolerance or goals or just investment philosophy. But on the front page, there's a space. So I'll have you guys all make a horizontal, I don't know if any of you guys can see this, but a horizontal rectangle, and make 3 different boxes. Because what this slide is showing, these are different buckets, and we're just going to talk about different vehicles. So this is kind of like when Terry was referencing, hey, we're going to talk about some other options or go a little bit deeper. Yeah, I mean, you guys can do it wherever you want. I'm just showing you how I did it. But any area that you're going to look at your notes is totally fine. So 3 boxes. The first box, write home run. The middle box, write aggressive. And the third box on the right, write safer. And so on that third box, within safer, put a dotted line in the middle, and then you're just going to divide it in 2 different halves. Long-term and short-term. So I just write LT or ST. Because this slide shows more from a type of vehicle. So this kind of dovetails really nice. This slide in particular dovetails really nicely with what Terry was talking about. So Terry was talking about a lot of what we refer to as qualified plans. So that's this bucket here that says qualified. So when he was talking about 401ks, traditional IRAs, SEP IRAs, simple IRAs, 403Bs, 457s, we had a couple questions there. All of those from a pre-tax perspective are under that qualified bucket. And then, we talked about Roth, and then non-qualified, this is after-tax investing. So the same type of investments that you put in an IRA, you can put into accounts that are not earmarked for retirement. Because really the difference between this non-qualified, qualified, and Roth is really just tax treatment and accessibility. So generally, Roth and qualified, 59.5 for the most part. So your specific age of 59.5 is when you can access it. And for qualified dollars, you're going to pay taxes at your personal income rates. So very specific to your situation, specific on the state your primary residence is in. Roth not going to pay taxes. Non-qualified, that is going to pay at capital gains rates. So capital gains rates, there's 2 different types. There's short-term capital gains rates and there's long-term capital gains rates. Generally speaking, long-term capital gains rates are a lot better. So short-term capital gains rates are the same as your income. So again, let's just use a common number. Let's say your effective taxable income rate is 20%. That's what you would pay for short-term. If you're anything that's long-term, then the difference is 1 year. So if I hold an investment for less than 1 year and I sell it and I make money, I'm paying it short-term. If I hold it for longer than 1 year, so if that's 1 year and 1 day or 10 years, I'm paying it long-term capital gains rates, and that's 15%. So as we get back to this little box here, or these 3 boxes, these are 3, really essentially we try and boil all down to strategic or what type of money we're talking about. There's home run money, there's aggressive money, and there's safer money. So home run money, and that's where we kind of split from the slide. Home run money is not necessarily something everybody's going to get into. So probably the most common form of this is entrepreneurship or starting your own business. And think of very famous billionaire, someone like Jeff Bezos, right? He did not discipline and save his way to billions and billions and billions of dollars. He built Amazon and owns a majority of the company. So Elon Musk, Bill Gates, most of these extremely wealthy people created something out of nothing. And so not everybody's going to do that, and that's okay. But it is a form of wealth and a form of money and ways to generate that. So other forms of home run money is you can kind of be a passenger on that, right? So things like stock awards, stock options, this would be kind of that second bullet point, or equity in your company. So you can work for a company, whether it's publicly traded like Amazon or a small, closely held business that gives you these types of benefits. So all of those are, maybe a watered down version of that business. Now, real estate is another form where people have maybe owned properties or worked in businesses that develop properties and get stakes in these types of deals. And then private equity is probably the last one that, again, these are all things that not everybody, you don't have to get into these things to be successful financially, but they're out there. And I would say, as our term home run implies, they can really work out in a big way. They also can turn into nothing. And so that, as we talk about risk, that is a little bit more real with those types of money, right? If I go out and I start my own business selling widgets or whatever, that might fail. And quite frankly, research shows that most do, right? Whereas the S&P 500, as we use that example again, all 500 businesses failing at the same time is a little less likely than my lemonade stand not doing so great on a cold Saturday afternoon. So now we get to aggressive money. So this is where the lion's share of your retirement money or future investment planning money should go. So generally speaking, this is all going to be money in the market. And so these bullet points would be 401ks, 403bs, IRAs, Roth IRAs, that after-tax non-qualified investment accounts, whether it's an individual or joint with a spouse, all of those things can behave the exact same way. And then there's things like variable annuities. We maybe can circle back to that later. It's technically a type of aggressive money, but this is all money that is volatile. It's not always going in a straight line. It can lose value in the short run. But what history shows us is that these things tend to get a much higher rate of return over a long period of time. So we'll go through some of those historical numbers in a little bit. But then safer money, we divide into two different sections, mostly around time horizon. So there's long-term safe and there's short-term safe. So longer-term safe typically is where you'll see things like bond funds or municipal bonds. You'll also see fixed annuities, another example of a long-term safe. Life insurance as an asset generally is best used in the long-term safe. Life insurance, again, probably a conversation for a different day, at least at a detailed level. Life insurance is not a good short-term investment. If it is a good plan, it's probably for the long haul, at least as an asset. And then a CD ladder, depending on your time horizon or how you're personally defining long-term, can be a good safe route. Certainly a lot more now than it was 5 years ago and 10 years ago, because CD ladders are only going to give you 1 or 2%, and it's fully taxable, so your tax equivalent yield gets to be pretty low and less than inflation. But right now, those are more like 4 or 5%, still taxable, but is a little bit more reasonable as it pertains to upside. And then short-term safe really is just more or less bank instruments. So again, CDs also could be short-term safe. That work depends on the length of the window you're buying it in. But money market, savings account, checking accounts, those are perfect short-term safe. And there's really nothing better out there than those vehicles. They have a substantial amount of FDIC insurance, which most people don't need, but generally you're going to have $250,000 to $500,000 of FDIC insurance backing those things. So it's about as safe as you can get. Generally the yield's really low. Again, those things recently have gotten a lot better. But that's not why we use those tools. Those tools, as we get back to risk and covering those things, they're more meant for safety and liquidity because you can access them whenever you want. Whereas we compare it to a 401k, I can't touch that whenever I want unless I'm older than 59 and a half. But I think all these things, again, we had a nice conversation towards the end of Terry's conversation where, hey, these things are not better or worse than each other. they all have a different, a hammer is not better than a screwdriver, right? They just have different uses. And so I think some of it comes first and foremost understanding your situation, understanding what your goals are, and then figuring out, hey, which ones of these are best for me right now. And over time, generally, they all kind of make sense for people, but it doesn't mean you have to check the box on every single one. I mean, it depends on your life stage, depends on the decisions you've made to this point, but they all can serve you well. It's just a matter of, are you using, where these things get problematic is, are you using, did you hire a plumber to fix the leak in your roof? Like that's where you can run into problems in this type of stuff. It's like, am I using life insurance to fully fund my retirement? Well, when we could view it like that life insurance is a pretty bad option to fully fund my retirement. But if I'm saying, hey, well, do I want some safe money that's not tied to the market and just maybe have like 5% of my overall net worth in something that doesn't track with the market? No, it sounds a little bit better. But at the end of the day, there's a lot of other things that don't track with the market, right? So it doesn't mean that life insurance is this great silver bullet. And again, like Roth IRAs, we can go really deep and all this tax-free treatment can sound wonderful, but it doesn't mean that it's better in the absolute than every other option. And for some people, you can't even use those things, so it's a moot point. If you make too much money, you become ineligible, or maybe you work for an employer that doesn't offer a Roth option for your 401k plan. These things are very common, unfortunately, so for a lot of people, just might not be an option to even consider, and you can move on pretty quickly, so it doesn't mean that it's good or bad. And please, as questions come up, please fire them out. So this, we're going to kind of dive deeper into, well, actually, we'll come back to this just in the interest of time. So this, I think, the next two slides. So what we're talking about here, getting back to the concept of volatility. So this might be hard to see the exact, what this is showing is that this is all of the stock market returns from 1926 to the end of 2021. So each blue line is a positive year in the market, and each orange line is a negative year in the market. And so what this is showing is if you evaluate the market in 1 year intervals, 74% it's positive. So that still means, again, if we're thinking about 1 year, 25% chance my money's going to go down. So if I'm saving for something in the year, I don't know if I'm okay with that 25% chance. So this is why a lot of times we say, hey, you don't necessarily want to invest for the short run, because there's a decent chance, still likely the money goes up, more often than not it will, but do you want your home goal to be thrown off by a 25% chance? You may have saved the right amount of money, but something outside of your control threw that goal off. We don't have to take that risk for something like that. But as we think longer term about goals, what this starts to look at is the top chart here. Now when we're looking at it in 5-year increments, and then the bottom one is 15-year increments, what you can see is as you widen your time horizon and how you're looking at the market, the more often or more likely it's going to be up. So what this is showing you is that if you take this is the top chart, if you take a 5-year window and you look anywhere in the last, call it 100 years, there 87% of the time the market was up over a 5-year period. And then what the bottom one is saying, if you widen that to 15 years or longer, the market's always been up throughout history. And so when we talk about being aggressive for the long haul, this is part of the case as to why. So those rate.
I'm sorry.
So we're looking at the same.
One's 5 years, one's what's the bottom?
15 years. Yes. Yeah, so it really is what we're doing is we're widening the scope in these 3 charts. We're saying, hey, the longer out we look throughout history, the more likely things are to be up or higher in the market. And so, again, investing is great, and we still want to make sure you have the right risk tolerance. But again, it's kind of that old adage of making sure you're using a hammer when you're trying to hammer a nail. Don't pick the screwdriver. So, the market is the long-term hammer for the long-term nail. And, again, there are some extreme folks out there that, are okay with the risk for the short term with the market. I'm not one of those people, but they're out there, right? So that doesn't mean that you're welcome to try, right? And 75% of the chance, it probably does work out. We'll skip this one this is another time-weighted deal. So, how we do it? Will we start at 12:40?
Yes, about on the 1:30 mark.
Oh, okay. All right. we'll skip over a couple of these. We can come back if need be. So, but this gets into step 3 of diversification. So, this is kind of a high-level view of different types of equity investments and then safer investments like bonds or fixed income and cash. So we'll go through in a second a couple of more detailed as it relates to asset classes and areas to invest. But when we talk about what is aggressive and what is conservative, it's really the concentration of how much of my overall portfolio, what percentage is in equities or stocks, and what percentage is in fixed income, cash or bonds. And so the more I have concentrated in equities, the more aggressive you consider a portfolio. And conversely, you know, if I have 100% in bonds, that's bonds and cash, that's the most conservative I could be. And so, again, you can have multiple portfolios that are engineered for different goals. So if I'm trying to retire in 5 years, but I want to pay for a grandkid's education in 15, I can have, you know, a bond-heavy portfolio for my retirement, but I can have an equity-heavy portfolio for that education goal or that gift goal. And these just kind of list, we kind of went through these in the types of money, so small cap, large cap, international stocks, we'll talk about that in a second, but money market funds, CDs, government bonds, municipal bonds are all different versions of that. So this is kind of an eyesore, we call this the investment quilt, but it's really kind of cool. So what you're looking at is all of the specific asset classes in the market. So the dark blue one, that's the S&P 500 that we've been talking about, but then there's another 6 equity asset classes. So the orange is small cap. So those are United States based companies that, so like an example of a small cap stock would be Peloton. So that hasn't done very well lately, but it's an easy to identify company. Mid cap, again, it's bigger than small cap, but it's still based in the US. So a common company that's a mid cap stock is Roku. So if you guys have Roku at home on your TV, that's a company that's in the mid cap. Large cap, that's S&P 500, we already talked about that. Real estate, so that's more institutional, commercial type real estate. So don't think about it in terms of your like value of your home. That, you know, that is technically real estate, but for investing purposes, this is more like skyscrapers and, you know, industrial buildings, manufacturing buildings, office buildings, things that are owned by large funds. And the white square is a diversified portfolio, so we'll talk about that in a second, but that's really a combination of all these things. Fixed income, that's the bonds. International developed and international emerging, those are just internationally based companies. Developed markets would be an example of a company that's based in a European country. Emerging markets would be an example of a company that's based in Brazil or India. And then cash, that's the same thing as money markets at your bank or savings at your bank. And then the yellow is, that's commodities. And so commodities are tangible goods that you can invest in. So probably the most common one that you'll hear about, doesn't mean it's necessarily the best, but gold would be an example of a commodity investment. So you also can invest in things like oil, lumber, soy, but tangible goods that are bought and sold. And so if you can zoom out real quick, it's interesting. Commodities is one that has had a very interesting 15 years. So you can see this goes back to 2008 is the far left column. And so you can see commodities has a really, really bad run over the last 15 years. But last year in 2022, so that's the second to last column on the right, it was the best. And so what we know about commodities is it's the only asset class that's positively correlated with inflation. Which stands to reason. These are goods, again, that we're buying and selling. So as cost of goods are going up rapidly, really that's a function of those exact assets that you're investing in. And so when we think about the last 15 years, we didn't have a lot of inflation, especially in the early teens. And really inflation started to return at the end of 2020. You can see it in 21, and then 2022, that's all the headlines were about. And so that's kind of coming back to earth, but you can see commodities did not have a great last 15 years. But what I love about this slide is it implies it shows how random the market is, right? You can see a couple of trends that stand out, like commodities not doing well. But what really stands out to me is that white square, the diversified portfolio, it's right in the middle. Not exactly every single year, but more or less, it's almost a straight line straight through everything. And so that's what we want to build over time, because what the two columns furthest on the right, if we zoom back out, Actually it's cut out. So the compounded return, you can see it's smack dab in the middle. The column that's cut out on the right that this slide's missing is there's a measure of risk that shows all of these asset classes and diversified portfolio measuring the risk that's involved with each one. And what it shows, you can kind of see it. This is the white slide right there. So what you can see is that you're able to get a little bit better returns, middle of the road returns, but a lot less risk than all of the other asset classes individually. So you can see each one is there's that large cap. So diversified portfolio is less risk than large cap, and so on and so forth. So each one, again, the slide just got cut off. That's my Photoshop skills at work. Sorry about that. Again, so this is what the diversified portfolio is, just one example. These are all indexes, so these aren't any specific investment products, I guess they do exist. Like all of these asset classes have index funds you can invest in. What the large point here is you kind of want everything. It's just a matter of which areas should your portfolio be in. You do want commodities, you just don't want a lot of commodities, but should you have 2% in your portfolio there? Should you have 5%? That's going to depend on your situation and what you're investing for. Because there are people that shouldn't have it at all.
What'd you say it was on the top of the risk one, on the one that's cut off there? What was on the top of that?
So this one is, I believe that's real estate up top here. Yeah, that's real estate. Now, that brings up a good question. This chart we refresh every single year, and those last two slides, what did the best over the last 15 years, it's different every year we update it. Because it's all based on that data set. And so that's the thing, is like it's a very interesting slide to observe, but it doesn't have a lot of actionable advice because these things change really, really quickly, and they generally are not what you're expecting. If you looked at this slide in 2020, so if we zoom out real quick, the version we had in 2020, all you would have seen is commodities is either doing the worst or it's in the bottom half. So at the time, would you ever guess that 2 years later it would be the best asset class? And the point is to not guess. In the short run, these things cannot be controlled and cannot be predicted.
Real estate's on the bottom of that one. So
Right. Yeah, it's interesting because like real estate and international merging, I think are good examples as you look throughout the 15 years, is that international merging has 4 years where it's the worst. It also has 3 years where it's the best and 1 year where it's the second best. And real estate's another one where real estate in 22 and 20 was the worst. In 21, it went from worst to best to worst. But then as we look throughout a couple years back, it has 4 years where it's the best.
That has a lot to do with recession too, though, doesn't it? Real estate?
Like it had to do with it caused the recession?
No, like where the stock fits and that stock portfolio would fit. This is what this is, right? Are different
they're all in different
areas.
investment things.
So they're all asset classes. So you're wondering, is it a good thing or a bad thing to hold during a recession, or what?
Yes.
Depends on the recession.
Okay.
Because what we're going through right now, which 5 years from now as we look back, or 10 years from now as we look back, we're probably in a recession right now. It hasn't been anointed. The news cycle is doing a good job of changing definitions. We're probably in a recession. And so, how real estate has behaved over the last 15 years, some of that, not all of it, but some of that is the low interest rate environment that's involved in borrowing to buy these types of investments. So on a go-forward basis, it's not going to be quite as easy to make money in commercial real estate as it has been in the last 15 years, because I used to be able to go get a 2% loan to buy a $5 million apartment building, or me being some big fund out there, but now I have to borrow at 6%. So the math still works, you can still make money, and depending on the development project, these things can definitely work out really, really well still, but it's not it's not as consistent of a rising tide that raised all ships. And so each recession is a little bit different, right? What we're in right now is some core traditional inflationary pressures. You know, they came from really non-traditional sources, right? A pandemic generally doesn't come around all that often, but it caused some serious inflation problems. And this also, the war in Ukraine also has a role in this. But, you know, the last recession we had in 2008, it largely was some fraudulent behavior in how mortgages were being underwritten or not underwritten, and how that they were being bought and sold and invested in institutionally and misrepresented. And so, you know, like that doesn't necessarily, like those specific dynamics maybe are a little bit more closely tied to real estate, but they are separate enough in that, hey, if you pull together, you know, there's an unbelievable amount of money in this world. It is staggering how much money exists in the world. So, you know, most of us in this room are going to have to buy real estate using a loan. When we're talking about institutions, they're not always using loans to buy these things. They're just going out and they're tapping each other and says, hey, who wants to put $100 million in? We're building a skyscraper. Yeah. And again, like, it's funny, this debate, if we talk about real estate and you know, things that we're all publicly aware of, there's a huge debate of like, oh, should the taxpayers fund a stadium? You know, like right now we're looking at American Family Field. Guess what? Every business in Milwaukee has gotten the same deal the Brewers are asking for. It's just not that interesting to talk about. Like Northwestern Mutual got the same type of deal that the Brewers are asking for. And Northwestern Mutual has an unbelievable amount more money than the Milwaukee Brewers. But nobody cares, right? I'm not Ryan Braun. I'm not Christian Yelich. Nobody cares, right? Whereas the Brewers, and it also is different because Northwestern Mutual is a private, mutually owned company, whereas the Brewers are owned by a billionaire. So it makes for a much more interesting, frustrating narrative that has correctly captured eyeballs. But these things are a lot different, and it's a lot more widespread. It's just when Northwestern Mutual builds a building, we're excited because that creates jobs. But the city of Milwaukee still pays for it, and as do all of us in this room if you live in the county.
Yeah, you know, when I first saw this slide about a year ago, I was like, ah. But, you know, once I figured out what it was really doing, this is like my favorite slide out of everything that you show. But I think last year you had talked about, for example, you know, when you are retired and you are taking distributions from your IRAs and, you know, investment funds, how Northwestern does it. You talked about how they take from the ones that excel throughout the year.
Oh, yeah.
Can you touch on that?
Yeah, so we'll jump ahead a little bit because that is one I want to make sure we get to. So we're definitely. So I think, is this the one you're talking about, where we're talking about systematic distributions through down markets and how we approach maintaining a port? Okay. So before we move off asset class investment, any other questions there? Because I think this kind of does dovetail nicely with that. So
That's hard to see.
Yeah.
this might be a good one to move closer if you can't see. Because what we're going to talk through is we're just going to talk through an individual or a family that this is, and so we're going to go through real market performance here and systematic distributions with someone who's 65 and starts with $1 million. So, Dave, if you can, don't zoom in anymore, but if you can just move it over to the left, because there's a column over here that I want people to be able to see. Perfect. So what this is showing you is someone who has, and this concept, like $1 million, that's a nice round number. This concept is consistent at any linear level. So whether you have $1 million, 100,000, or 500,000, this concept's going to be the same mathematically. So this person retires in 2001. They've got $1 million, and they're living on. So this column here is how much they're distributing out of their portfolio, and then this column shows how much that million is at the end of that year. And so this is a very, very straightforward and traditional way to approach retirement distribution. And so what this distribution is the same. It just goes up with real inflation that happened historically. So what you see is that 60,000 slightly grows. Let's just say it's at 2.15 is what the slide uses. And then they have a traditional 60-40 balanced portfolio. And we're talking about real investment returns. So the slide we just looked at with all the colors. So what you can see is that $1 million after 20 years, so this ends from 2001 to 2020, this person now has $90,000 left. And part of why that is what this highlights, this time frame, is what's called sequence of returns risk. And so what that means is that the returns we get in the market generally are going to be better over time. But each individual years, as we think about that 75% of the time they're good and 25% of the time they're bad, they're completely randomly distributed. And so when you experience those bad years in your retirement matters a ton. And the catch is that you can't control that. So this particular time frame is very intentionally chosen because this person experiences 2 bad, more or less recessions within the first 10 years of their retirement. Because they retired in 2001, and then you got the dot-com bubble right away. And then the market recovers a little bit, and then you have 2008, the Great Recession. And so what happens here is that you're taking money out systematically because you're in retirement, you're in your golden years, you're going to the beach, you're going to see your grandkids, all of those things you dream about. So we're funding that lifestyle. But what's happening in the background is, hey, we subtract money out of the portfolio from $1 million, and then the market goes down 10%. And so that 60,000 we took out, now that portfolio doesn't make a full recovery. So you're taking double hits, and you can't control this. And so you're left with almost running out of money. Again, when we look at what that cost of living has now gone to, this person has 1 year left, right? Last year they spent $89,000 for the same exact lifestyle that was $60,000. This is just natural, and consider the fact that this is an extremely low inflationary period historically. It normally grows a lot faster than this, and it is right now. But that person effectively has 1 year left of financial security. And so the next slide shows how we would advise you approach this dynamic. Because if we can zoom the same way here. So what this is showing you is it's the exact same set of circumstances. Same market data, same net worth, same lifestyle. What we're adding is having what we would refer to as a cash reserve, or just non-correlated assets that are outside of the market. And what that allows you to do is react efficiently to the market. Because again, we kind of want to beat the drum of we're not going to be able to market time, we're not going to be able to predict what's going to happen. There's a couple of good slides that we'll finish with on how and why we can't predict these things. But instead of selling from your market-based assets to fund your lifestyle during a down market, have a cash reserve, again, whether it's in a money market, CDs, life insurance, doesn't matter as long as it's not in the market. And so that way your lifestyle doesn't have to skip a beat and your portfolio is protected so that it does make the full recovery. So, because historically, that's what some of those slides we skipped over. Historically, it only takes about 15 to 18 months for the market to recover during a correction. Right now we're kind of on the long end of that. But in 2020, COVID, it only took 6 months. And it sounds good, but 2008 actually wasn't that long either. That was only 18 months. This one's actually, it hasn't reached the depths of 2008. It's not, the bad isn't as bad, but we're actually in the territory of it lasting longer than 2008. It just doesn't feel as bad. So again, we don't know how long those are going to be. And so what we would advise is having a cash reserve to fund 2 to 3 years of your lifestyle in retirement. So when you're before retirement, we think about an emergency fund in terms of expenses that I can't afford out of my paycheck, right? So I got to replace my roof, or I got to replace my car. I've got a rainy day fund to pay for that. In retirement, all of my investments are liquid. I don't have to think about those things. It's more of an economic emergency fund where we're saying, hey, I didn't know coming into 2022 the market was going to take a dive. Now I'm going to pull from my cash dollars and let my assets make a full recovery. And what this shows you is that over the same exact market performance with the same starting balance, and you take the same distributions, you're just having a different source fund the down years. This person now, after 20 years, still has $1 million with the exact same set of circumstances. You're just holding a little bit more out of the market.
Day after.
Day after?
It rallied quickly.
The best single day was 8 days later. And it went up 9.38%. In 2021, the worst day was January 27th. It was down 2.5%. March 1st was its best day. It went up 2.38. In 2022, pretty bad year. The worst day was on September 13th. It went down 4.32%. The best day, November 10th, it went up 5.5%. Again, another extreme year. This one's crazy. 2008, the worst day was October 15th. Negative 9% in one day. You had $100,000 in the market. It was $90,000 by the end of the day. The best day was actually 2 days before, on the 13th of October. The market had gone up 11%. And keep in mind, at that point in the year, the market had already lost, to that point before October, it had already lost 30%. And so consider that data and then how you're probably feeling in those times. The market it's been a war zone for 9 months. You're probably not feeling great. We're left tempted to make illogical decisions that feel right. It's like what my gut tells me to do is get out when it's bad and then get back in when it's good. And so I think that's where I'll finish, is the next slide shows what happens when you try and do that. And so what this is showing somebody who has $100,000 in 2007. So we're right before the crash. It's sunshine and rainbows. Everything's great. 2007. I'm graduating high school. I feel like I'm the king of the world, and I have absolutely no money. And there's three different examples. So this blue line is saying, hey, what happens? That person has $100,000. What happens fast forward 10 years after the crash? So they experience all the way down in 2009 when it bottoms out. And then what happens 10 years later? Where are they at? That person now has $300,000. They stuck it out, turned around. 10 years later, you've tripled your money. Correct.
Yes.
Scenario number 2, the blue line. The person gets real scared, as they should be. Nobody knew what was going to happen. So they say, hey, I'm going to get my money out. I don't want to do this risk anymore. I'm not real comfortable with this. And then a year later, the market's a lot better. What happens to that person? Well, that person gets back in 2010. That person, they've doubled their money, but they gave up about $100,000 because they fell into fear. Really. And then what about the person that exited the market? So what happens is in 2007, remember they had $100,000. They get out during the crash. 10 years later, they never get back in. $57,000. And so a lot of this is behavioral. We're hardwired to follow these temptations and these fears. We're not really hardwired as just our human psychology is not hardwired to be a naturally good investor. We all fall victim to these things at some point, and we don't know what they're going to look like in the future, right? A pandemic, it didn't really scare me, if I'm being really all that honest, right? My parents are young for people my age, and they're very, very healthy. I'm very lucky, so I wasn't worried about my parents. And I was 32, and I'm in decent shape, and I'm very fortunate to have good health. So personally, I wasn't all that scared.
Right.
Down the road, I might be terrified, or someone else, was probably very scared, as they should be during COVID, right? So we're all going to have a different emotional experience, and we don't know what the next one's going to look like, right? Like the next one might scare the bejesus out of me, and you guys might feel great. You're like, Charlie, why are you freaked out? We don't know. Right? And so I think we're a little past time, so I've got a couple other things if we want to do questions. I don't want to eat into time. We can either do questions now or we can do questions at the panel. But I think some of this, I'll leave you with this quote. This is not me. This actually came from that Nick Murray book. The only outlook that aligns with the historical record is optimism. Faith in the future always works. So you look throughout history, we've always gotten through it. It's always worked out. But if you were in that moment in history, there was no compelling case for us to get through it. But optimism is the only outlook that aligns with the historical record. So I'll leave you with that, and we can do questions at the panel.
Yeah.
Cool.